Ladies and gentlemen, welcome to the Think Tank. I am Brian, one half of the Think Tank guys, and this is
Eric
Patterson. Eric, we are here at the Think Tank where you and I both know, and our listeners and watchers and viewers know, this is where mind and money collide. And I'll tell you what, the project that we're introducing here today, because this is an introductory video for our 52-week project. A lot of our listeners and watchers have seen this up to this point. We're calling this thing the 52 ways to put your policy to work. Both you and I are excited. It's football season. It's week 1 next week. Just like the kickoff of the season, this is the kickoff of the 52-week project. So tell our viewers a little bit about what they got coming in store.
This has been a project that you and I have both really been looking forward to.
Yeah.
If for no other reason, because, our clients want it. I can remember getting my policy activated and feeling like, I had this great vehicle in my hands, but not really knowing that there were different ways I could apply it and take advantage of it, but there was nothing really out there in terms of an instruction manual or anything where I could get ideas on how to use it and take full advantage of it. So we are filling that gap, we're filling that niche, and we're excited to do so. So we've got a lot of great ideas, and this is the kickoff. So
it is, man. It's so exciting. I think back to when I first opened my first policy a good 10 years ago. I always tell clients of ours that, I wish I had some of the knowledge, even just a little bit of the knowledge that I have now. I wish I had someone like us to kind of coach us along. And then kind of to your point, like even to this day, there's no real instruction manual on all the various different applications of this thing, that we're going to be talking about here. And our clients know, I'm drawing things as we're talking here. Our clients know what we're talking about. They know we're talking about using the cash value account inside whole life insurance. They know that that's part of the perpetual wealth strategy that we teach. But there's people that watch our think tank that aren't clients yet. So they're probably like, what the heck is going on? We're definitely going to be posting some stuff that helps bring them up to speed. But really what we're talking about, I'm excited. I'm about to use my whiteboard.
All right. It's debut.
My whiteboard for the first time.
Debut.
We're talking about using that cash value account, that whole life policy, as an asset and not viewing it just as a pure expense. And then what this 52-week project is going to do, as we're going to share some stories and stuff today, talking about the principles, it's really going to help us see what can we leverage it into. How can we make the best use of that asset, knowing that it's going to just consistently and dependably grow for us.
You look at the statistics around the folks who actually use their banking policy the way that we have designed it for, and it's actually kind of depressing, Brian. You and I both know we educate around utilizing the cash value for the living benefits in all sorts of different ways. But the reality is, most people will let the money sit there, which is fine. You're still better off in a lot of ways than, say, in a 401k or an IRA. But the fact of the matter is, we are going to provide that level of knowledge around how to really, and just a reminder, if you will, of all the different ways that you could really take advantage of your policy. And so I'm excited for that. Again, Absolutely. Like you said, I wish I had something like this when I was
Absolutely.
started.
Just got off the phone with a client today, and we were kind of chatting. He's like, well, what if I can get a loan for cheaper? Because we're going to talk about borrowing against the cash value inside these accounts. What if I can get a loan for cheaper? What if I can get a loan for zero? The answer is, well, then possibly go do that, right? But the fact of the matter is, we're going to chat about how, the cash value account gives us all these different options.
Sure.
Right. So let me rattle off a few, and I'll probably put them around the video here in some capacity. Let me rattle off a few of the attributes. And then if you have, and this is kind of a reminder for current clients that have these accounts. And then also for the folks that don't have them, it's kind of a snapshot of what this asset does for the people that hold it. And then if you have anything to interject, please, Eric, fire away. So, the attributes of a whole life policy, especially when we build it the way we do, where it has cash value, significant cash value from day one, that cash value starts to grow. It grows dependably. It grows irrespective or irregardless of what happens in the market. So it's immune to market volatility. It's dependable because it happens every single year. When interest is credited, it's permanently yours. You're eligible. You have contractual guarantees. I need a second hand here because I just went through 5 different things. You have contractual guarantees, right? You're eligible for dividends on top of it. You have a guaranteed line of credit against that account. No questions asked, no credit check, no application, right? You have a death benefit just because you're holding your cash somewhere else. And you have a lot of tax benefits wrapped into that entire thing. So this thing is really unique in the fact that, we can get a couple of those attributes in different places, but the fact that we can have them all together, and the fact that today in our world, there's really no good place for cash aside from a whole life cash value account that you and I and our clients are well aware of. It definitely leans towards, or it definitely encourages a conversation about this asset because of everything you can do with it.
Sure. As you were rattling off the attributes there, you and I were talking about this the other day and kind of what we wanted to kind of convey in this particular intro kickoff message. And, last night I'm prone to have these epiphanies, if you will. And last night I feel like I had one. So let me just kind of spring it on you, see how you feel about it. I'm a big fan of metaphors. And I remember back when I was a young kid, I was a Cub Scout, and I made the transition into being a Boy Scout. I don't know if you've ever had that experience, Brian. Yeah. So it's an amazing experience. It's like it's your journey of becoming a man, if you will. Mm-hmm. And one of the top three, maybe top 5 gifts I ever received was this right here.
You brought something. Oh, the Swiss Army knife.
Here.
That's a real Swiss Army knife too.
It's a real Swiss Army knife. Okay. And I can remember just how the feeling I got when I got this as a gift, when I got into the Boy Scouts. Sure. And as I went camping and I was able to have a chance to really use this amazing tool. And so I thought about this the other day. It just reminded me of what we have in place here. We've got a lot of different attributes to our policy. We have the tax-free. We have the private contract. We have the death benefit. We have the cash, the liquidity of the cash value. We have all these different things, right? And I'll tell you, when I was a kid, of all these tools, 99% of the time, I just use the knife.
That's right.
I just use the knife, okay? All the different attributes, I just use the knife. And so
that's great.
My point being, there's a lot of different uses you can get out of this. So these are the attributes, right? And then there's the application, the principled application of these attributes. So if you don't know how to use any of these tools, then it's essentially useless to you, right? Yep. There's always potential, but you're not really getting the most out of it, what you can get out of it. And so what we're really going to do here is we're going to show you the principled application, the leverage, the ways you can leverage it, the way you can use your policy, the way you can control all these different things about your policy. And so that's what I wanted to show you today. And I thought this was a great metaphor for that. So
I'm going to thumbs up the video just for that reason. I tell you what. And we probably will get a couple of thumbs up for that. That's terrific analogy, man. A terrific, well, you actually called it a metaphor. So I'm going to stick with the metaphor. Mm-hmm. Terrific metaphor because of the fact that's what we want to accomplish over these 52 plus weeks, right? So let's talk about some of those principles. And again, I'll probably list these out. So we talked about the attributes. Now, what can we do with this account? What are some of the applications we're going to chat about? Effectively, we can just let it sit on our balance sheet, kind of like you talked about. It's going to be a dependable asset. But the fact of the matter is we have full control to use those dollars in some capacity through the leverage provision, mm-hmm. the line of credit. Mm-hmm. And the fact that we can then lean against an asset that's consistently growing and do something else with the money is pretty powerful. Right. I have a feeling you might have a story or two just about different ways clients have used that, or even you've used it up to this point.
And I do. I mean, there's a laundry list of stories, and they're always coming. We're in the unique position, you and I, Brian, to where we work with a group of individuals who are passionate about what we do. We interact with clients all the time. We're always surprised at the different ways that people are actually using their policies, the unique ways. And so we're in a position to where we're sharing these ideas amongst each other and of how clients are using their policy. I'll give you an example. One time, not one time, but I had another agent of mine was sharing a story about how his client was able to, he was in the market for a rental for a property. Excuse me, not a property, but he wanted to move to another apartment. And so what he did was he said, okay, I've got this cash value in the policy, and I know I'm going to be in this rental for at least a year, more probably longer. And so why not just negotiate with the landlord? And so what he was able to do was to take a 6-month chunk of that cash and offer it up to the landlord and say, hey, listen, I've got this money, don't know what to do with it. I'd like to be able to pay up front my mortgage, my rent, and but I'd like to get a little bit of a discount on that rent. This guy got a 10% discount.
10% discount on his rent. 10%
discount on his rent simply because he was able to negotiate and use his cash value, which he it was sitting there for quite some time, and so he figured, why not? He's going to be in this location, and guess what? That money's still growing for him in the policy. We'll get into that later. And so this is not all going to be just anecdotal. We're going to really take deep dives into the numbers and show empirically why this makes such good sense.
Absolutely. So. Great story, man. Great story. And this is just, this is going to be a testament a little bit to the strength of this collateral. I mean, most of the folks that watch this, and this is probably going to be eye-opening for the folks that don't know this, the number one purchaser of these accounts in the United States is in fact the very same banks that we just talked about in the Think Tank Bank series, right? They have billions, like $163 billion of cash value sitting inside these accounts because it qualifies as a tier 1 asset. And they make a bunch of money off our money, but then they have to hold on to some of the earnings they make. So where do they put it? They don't want it to be lazy. Right. They actually sit a good 30 to 50% of that tier 1 capital inside these accounts. And they build and they use it for the attributes we talked about. They use it for retirement planning for their executives, right? The number 2 purchaser of these things are these types of policies and the cash value accounts are businesses. And as you and I know, the wealthy know how to use it. Real estate investors know how to use it. Our clients know how to use it. It's a very strong piece of collateral. The banks themselves know how strong it is. So I wanted to kind of talk about the leverage provision. And there's a drawing I like to use. Here I'm pulling out the whiteboard again, right? From a leverage provision, we're going to share ideas on how to use this account. But it's not the only place we can leverage. But the fact of the matter is we're going to have a lot more control when it comes to the terms about this, because we could borrow against our house and a bank might let us get up to 70% of the market value of the house, right? We can borrow from our 401k and we can get up to $50,000, 50% or $50,000 over 401k. Right. But and there's rules that we have to follow that the bank sets in terms, and there's rules that the custodian sets and the IRS sets. But down here against the cash value, we can borrow up to 95% of our cash value while that thing still grows because we're borrowing against it. And we get to set all the rules. So just that fact usually just lights a little bit of maybe turns on a little bit of a light in our client's eyes that says, wait a second, I can start thinking more strategically about this and effectively take more control back from the banks and some of the institutions that, quite frankly, don't want us to know about the use of this thing right here.
Right. You don't know what you don't know. And, when I say that to say we're conditioned to think a certain way. Banks make all the rules. Financial institutions make all the rules. And so therefore, if the bank or the government says we can only have 50% or 50,000, or if the bank says you only get 70%, and oh, by the way, you got to have a job, and oh, by the way, the market's got to be performing to where it needs to be, then that's the way things are. And so those of us with the banking policy, sometimes we forget that we are the ones in charge. We make the rules, our loans, our terms, and so it's good to have that reminder. And that's also what this is going to serve as.
It's funny. I was just a testament to your story. It's always fun for me when I'm not only teaching clients how to use the loan provision and we're designing the policy, but inevitably, almost all the time, when a client goes to use the policy for the first time, we'll be talking about it and we'll strategize a little bit. And then they'll say, so Brian, how much do I have to pay back? And usually they're shocked when I say, no, because listen, we don't want to disrespect our own cash and we don't want to not treat ourselves the same way we treat banks. But they're always a little shocked when I say, well, how much do you want to pay back? And they're like, well, wait a second. And it's like, yeah, you, and I'll help you with it, but you get to control that. And that is just, they're not used to that because every single other loan up to that point in their life, they were immediately put back on a payback schedule. They were following someone else's rules. And the shift that can occur with this, which we're going to continue to massage through the course of those 52 weeks, the shift is powerful.
Yeah, I agree. I think back to, again, putting my policy in place and where this really big, crystallized in my head, and I realized this was the real deal was when I took my first policy loan. And again, I go back to the statistics around those policies we put in place for folks and those who never take a policy loan. And so a part of this journey for us, I think, I like to be able to offer up a challenge to the think takers out there who have a policy. If you've never taken a policy loan, take a policy loan for something, just for anything. Just go through the motions and just see for yourself how easy it is, and maybe apply it to one of the different ideas that we talk about over the course of 52 weeks. But I encourage you to do that.
Yeah, especially since these ideas, this is a perfect transition. And you and I are just kind of like, we know what we want to talk about here today, but we're kind of flying off the cuff, which is great, especially with the fact that we can use these policy loans either from a consumer standpoint or obviously an investor standpoint.
Sure.
Absolutely. Yeah. So what a great challenge for our clients who may say, well, Eric, I don't know how to do private lending. I don't know how to do real estate yet. I don't know how to do, oil and gas or anything that we're going to come up with down the investor road. Well, do you ever use a credit card? Have you ever used a personal loan at a bank? Yep. We can start going down that road, and we can talk about, using it from a consumer standpoint. And there's even strategies. I know you put together some good documents we'll end up sharing. There's even some strategies, even if you want to use your policy loan, why don't you use a credit card first, get the points from the credit card company, and then refi it out and pay yourself back or pay the policy back, right? So there's a lot we're going to teach about there.
Yep, absolutely. Again, we'll get into that, but so I'm ready to kind of tell all right now.
I know. I kind of felt that. I was going to say, so Eric, we're gonna tell me if you have another story or two, because I'm thinking that we're going to wrap up this intro video. We'll definitely, if there's folks that need to understand the concepts of how to use the policy better. If there's folks that are new to this concept, Eric and I, that's what we do every day. We're in this every single day. So this is a perfect opportunity, especially if you've been introduced to our channel through a friend or a client of ours. There's a perfect opportunity to say, hey, Brian, hey, Eric, can I have a half hour of your time? Send me over something and let's get together on the phone and shorten my learning curve.
Sure.
Because as you and I both know, and our clients will attest to it, the value of this asset on our balance sheet is extremely strong.
Sure.
And one of the primary reasons that we're putting together the think tank is not only to help our clients help our clients put it to better use, but also to make sure we're reaching more people so that they can determine if this is something that they should be using as well.
Absolutely.
Right.
Absolutely. So one more story. It's so recent. It's fresh for me. Had a client who sent me an email the other day. It was a gratitude email, and they'd had their policy now for 2 years, and they just bought their first house. And so, that's great. Congratulations. The thing about it though was that where they were 2 years ago, where they are now, just night and day.
Sure.
Had they tried to buy a house 2 years ago, it was questionable whether or not they would qualify. At the same time, if they did, the interest rate would have been much higher. And so we took them through the process of a debt reduction strategy, using the banking policy, moving outside debt to inside debt. Again, something we'll go over down the road, but key concept there, which allow them to essentially make that debt, bring it inside their policy. Now it's on their terms. All of a sudden, that debt's gone from the public eye, from the public domain, and their credit score skyrockets.
Powerful.
So think of all the residual effects, the ancillary effects, positive effects of having a credit score that goes up. We're talking about difference in insurance rates, difference in mortgage rates, and that's what they sent that little note about, as far as them getting a really, really favorable interest rate. That'll affect them for the next 15, 30 years.
That's awesome.
So
that is just awesome. That is awesome. Yeah. So this is the kind of stuff we're going to dig into, man. So thanks you're getting me all excited. I can't wait to dive into this thing either.
Yeah.
So what do you say we wrap this up for the intro here? We'll point everybody, because we're starting to host this on our YouTube channel. So we'll do the little videos on Facebook, bigger stuff on YouTube. Like us on both. We'll I'm going to ask everybody, and we'll be asking them, start to follow us on YouTube, because then we actually get to name the channel after the think tank guys, which is really cool once we get through that. So keep an eye out every single week from here moving forward. We're going to be sharing ideas. Obviously, if you have any questions, and you want to dig deeper, hit us up with an email, put a comment in Facebook, and then we're just going to keep going over the stuff that you've asked us to cover, plus even more. This 52-week project is going to be fun.
All right.
So, Eric, why don't you sign us off?
B-Tech, when mind and money collide, fear and anxiety will subside.
That's right. You guys have a great week.
Have a good one.